Good morning and welcome to this Monday, September 25th, 2023 edition of Your Daily Five. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. And I've got a few charts I want to share with you today. It was about 2 months ago, I think on July 19th. Again, that was just about the time that this downturn started. I issued some warning signs back then. I remained bullish. I was bullish at that time, long-term. I remain bullish long-term. But I did spot a few things that I shared with you back on July 19th, right here in Your Daily Five. And I thought we were going to have a rough period. It's always difficult to say, is it going to be a week? Is it going to be 3 weeks? Is it going to be a couple months? This obviously carried on for a little while and continues as I speak to you today. But I'll say this. July 17th at the close to September 26th at the close, historically, is the worst time of the year to be in the stock market. I'm talking about the S&P 500, and I'm talking about data that goes back to 1950. Let me repeat this. July 17th at the close through September 26th at the close. Now, let me also remind you, today is September 25th. Tomorrow is September 26th. So when you look at this last couple month period, I want you to remember this is the time of the calendar year that we typically see weakness, summer doldrums, whatever you want to call it. We're getting ready to move out of that. As we do, I've got 5 really interesting charts for you today. But first, I want to take you over to Earnings Beats and let's talk a little bit about having you sign up for our free Earnings Beats Digest newsletter. I try to teach things that I've learned over the years. Would love to have you join us. You just go over to earningsbeats.com, scroll down. You'll get an area where you can sign up with your name and email address. Make sure you hit the subscribe button. It's a 3 times a week newsletter, Monday, Wednesday, Friday. If you're thinking, oh my gosh, I don't have time, it's 2 paragraphs in a chart. Literally 2 or 3 minutes out of your morning. And again, it's just maybe consider it a reinforcing educational piece. Sometimes I throw trading candidates in there, talk about sentiment. I talk about things that drive the market. Love to have you join me and join our Earnings Beats Digest community. Many, many, many thousands of folks and continuing to grow strong. And when we do free events at Earnings Beats, which we do a lot of during the year, we always reach out to our community, our EB Digest community, share room instructions to make sure you have an opportunity to attend. So it's great, free newsletter, certainly worth the value since it's $0. But we'd love to have you join us. All right, so what do I have for you today? Well, again, a lot has changed. I'm going to start off here first with a 15-month or an 18-month chart of the S&P 500. Because I'm not quite sure at this point whether the market, I'm not quite sure how much the market trusts Fed Chief Powell. And I can tell you right now, I don't trust him further than I can throw him. I think, the Fed, starting with Bernanke, tried to be very, very transparent. They wanted the market to know what their next moves were going to be, and they tried to give that transparency in advance. I thought Yellen did pretty much the same thing. I thought both of them did a pretty good job in that respect. I think Powell is horrible at it. Absolutely horrible. Say what you want, but, I've listened to him over the last couple of years throughout this pandemic, and he's always behind the curveball. He's always leaving the market hanging. He tells the market one thing, and then we see something else. Back in June of 2022, if you followed me for a while, I called the bottom back in mid-June 2022. Market took off from there. I think we were heading back to all-time highs. And then Jackson Hole happened, August 25th, 2022, right here. Look at this big red-filled candle. That's where everybody was selling after Fed Chief Powell started talking at 10 a.m. that morning. And that was his infamous more pain ahead speech, where he was talking about the stock market and how he saw more pain ahead. Well, I'm pretty sure that I've read the mandates of the Fed chief, and I don't think stock market prognostication is among anywhere on the upper part of that list. It's pretty much price stability and managing unemployment, trying to reduce unemployment. So we want to get as close as we can to full employment while still keeping prices stable. Those are really the two mandates of the Fed. Nothing in there about market prognostication. But anyway, Greenspan, remember in 1996, Greenspan came out and said, there was irrational exuberance in the stock market. 1996, remember? We went on to have 3 of the best stock market years ever after his speech. Great prognostication. Fed chiefs, let me tell you, they're extremely bright. They're brilliant people. But calling the stock market is not their expertise. It's like me going and coaching an NFL football game. I like football, but I've got no business coaching a football game. And when these Fed chiefs interject their own personal opinions about the stock market, as a former coach of travel teams in various sports, I liken it to I coached girls softball for 15 years. And I liken it to the fact liken it to maybe an umpire who wants to become part of the game. Rather than just making the calls, he wants to become part of the game and be the entertainment. Well, to me, that's a little bit about what we've been seeing with Powell. But anyhow, Powell, I think that speech broke that uptrend that we were in. Instead of going back to back to all-time highs, I think that ended the rally in the short term, went back down. We ended up getting a double bottom, slightly below actually, posting a new low. And then we ended up moving back toward all-time highs. Now, we haven't gotten there yet, but I think we were in a really nice uptrend. And I hear all the negativity. There's plenty of that out there in the market right now. I mean, you've got head and shoulder breakdown right here on the S&P 500, right? I mean, there it is. Of course, I'd ask you one question. Where's the huge volume that's supposed to confirm the breakdown and confirm the mass distribution? Because I don't see it on here. I see volume that ticked up a little bit last Thursday. I mean, really, if you look back, it was light volume compared to what we saw on the way up back in late May and into June, July. Had much more volume. We were trading routinely more, closer to 2.5 billion shares. Here, we were just a little bit over 2 billion. So I'm not seeing the panicked distribution, massive volume breakdown. The other thing is with head and shoulder patterns, I'm not a big fan of topping head and shoulder patterns that have an upslope on the neckline. Because if you think about the psychology of a topping head and shoulder pattern, you want to not only break this pattern of higher highs and higher lows, but you want to go down below the prior low to give it that sense, and almost like the Leaning Tower of Pisa. You want that thing leaning over so that when you do break the neckline, you're losing all prior price support levels. In this case, when we break, we're testing the August low. We haven't tested the June low when we first break down. And by the way, the best key area of support, the best level of support, in my opinion, on the S&P 500 is 43.05. That's the high that we saw back in mid-August of 2022. And that was the high that marked the series on the weekly chart, the series of lower lows and lower highs. That was the final lower high. We went back down in October, put in one more lower low, and it wasn't until we got through 43.05 that we actually confirmed the breakout. The problem with waiting for that confirmation is you miss 800 points of rally before you say, oh, yeah, here we are. It's a bull market. So you get out, I don't know, going back, there was actually a breakdown at about 4,300 of a head and shoulder pattern. And if you use that to get out, and then you use this move through 4,300 to get back in, what did you do? You didn't do anything. You might as well have just ridden it down and ridden it back up. Anyway, I think 43.05 is a pretty big level. Could we go below it? Yeah, I think in a panic situation, if things picked up, we could go down, and then I'd be looking for some kind of a capitulatory move to the downside. But right now, I mean, if you connect the recent lows, the October low, and then again, the March low, Look where it brings us, right to 4,300. So I'm taking a little bit different approach. And now we've got Fed Chief Powell. I mean, this is the next, you can see this big red arrow where I marked Jackson Hole. Here's Powell's higher interest rates for longer. He's got something new for us just about every time he opens his yap. But now higher interest rates for longer. So instead of expecting 4 interest rate cuts next year, he's now expecting 2. All right. Okay. That's fine. But when you look back at what he has said in the past, it started off with obviously inflation taking off. And he said, we need to see, when he started raising rates, he said, we need to see inflation showing a sign of coming back down. Then when we got the first initial reading of the CPI, core CPI, that was much lower, he said, well, we need to see a couple of these. You know, we can't rely on just one. And so the next time after we had the next CPI, we had 2 lower readings. And he said, well, we really need to see a series and we need to start moving back to our target. And then we'll feel a lot better about inflation. So what happens in this last one? Let me show you inflation, by the way. Here's the monthly inflation going back the last 30 years. Here is the 12-month rate of change. So here's your annual core CPI. It shot up from under 1.5 in 2021 to about 6.7 in 2022. Since then, it's fallen from 6.7 to 4.39. Is that not steady progress? Now, what he said in this latest policy statement was, well, it's, you know, we welcome the lower inflation, but we still need to see it moving back to our target. And as a result, we think we need to keep rates higher. Folks, this is not transparency. This is changing your tune at every meeting. All you have to say as a Fed chief is that one of our mandates is for price stability. We have to make sure we ensure price stability. And what that means to us is a 2% target rate. And we need to see rates continuing to drop toward that 2% target, or the inflation rate dropping toward that 2% target. That's all you need to do. It's all you need to tell the market. Market understands. If we get a pop up in inflation, it means the Fed's going to be more hawkish. If we keep coming down, the Fed is going to stand, you know, the course, which I think should be pausing. But anyway, it's just my opinion. We've now dropped 50% of that rise from that 2% level. Once we went through 2% and got back to 6.7, we've now lost half of it. And yet the Fed under Powell started out saying we just needed to see a move back down in inflation. And now here we are a year later with a significant, continued, consistent drop in inflation. And he still wants to talk about more rate hikes ahead possible, or higher interest rates for longer. Whatever. Moving on. S&P 500. A lot of people are talking about this head and shoulder top. How about a bullish wedge? You ever heard of that? Just throwing it out there. That's what happens when you go up and you connect a series of lower highs and a series of lower lows, and they're squeezing like a piece of pie. There you have it. ABC, correction. At major support. And if I move on, and actually before I move on, I know some of you are saying, well, you know, but the thing that's holding up the market. Well, actually, let's look at this. So here's the QQQ versus the spider. QQQ versus the spider. NASDAQ 100 versus the S&P 500. Think back to the beginning of 2022. I issued not a short-term warning, but a longer-term warning saying that the downtrend that began at the beginning of January could morph into a cyclical bear market, that signs were there. One of the biggest ones was the S&P 500 kept going higher to that final high, and money started rotating away from growth, which during an upcoming bear market or an upcoming recession, that's exactly what you would expect. The QQQ is loaded with growth stocks. The spider has some growth stocks, the S&P 500, but it's also more heavily weighted toward value stocks. So you got more of both. In the QQQ, it's mostly just growth, just aggressive growth stocks. So when the S&P goes up and that QQQ goes down, it's a pretty significant signal that money is rotating away from growth, right? Well, look at what's going on in 2023. This ratio, money has continued to pour into the growth area in 2023. S&P kept going up, and we kept seeing money rotate more and more into growth. Now we're rolling over, and here's your ABC on the S&P 500. But notice when the S&P just went down below its recent low, big top, and we got a topping pattern, head and shoulder, we're breaking down, right? Big problem. Well, I got a question for you. Why is money rotating into the QQQ versus the spider? And I know what you're going to say. You're going to say, well, it's just those few FANG stocks that are holding up the QQQ because they're more heavily weighted in the QQQ than the spider. And you know what? I'm going to agree with you. That is the reason. But I'm going to show you a couple things maybe you haven't seen or maybe haven't heard from the media. Here's your growth, large cap growth versus large cap value. And you can see this is pretty consistent with the QQQ SPY, right? Going higher. How about over here? How about mid cap growth versus mid cap value? This isn't your FANG stocks. Mid cap showing higher lows, even though the S&P's gone down. How about small cap? The worst area of the market, right? Small cap growth versus value is slightly higher now than it was at the previous low. So I don't know. I look at this and I see a market that is not signaling long-term weakness. In fact, it's gearing up for the next move to the upside. Now, I could also show you the equity-only put-call ratio. This is a 10-day moving average of the equity-only put-call ratio. I want you to think back to the July Your Daily 5 that I did. One of the things I talked about was the fact that traders got so complacent right here, right back in mid-July, the 10-day moving average went down to 0.50. And if you look pre-pandemic, you don't see many readings down there. And when you do, look at the red dotted vertical lines and look what happens to the market. Short-term top, a struggle, then a rollover. Short-term top. Right here, big top, a top. How about these two? Both tops. How about this one? Top. And this one that I wrote about in July? Top. When the market's like a rubber band. When it gets stretched too far in one direction, it normally will snap back. Now, this I use as a short-term signal. I don't look at this and say, oh my gosh, the market's panicked, therefore we're going to go up for the next 3 years. That's not what this is about. This is just when we start to see panic, we look for a bounce, a rebound in the short term. It may turn out to be a long term based on the other signals that I look at, but it's at least telling us short term, this signal is saying to buy when you get up into this 0.75 to 0.85 range. And that's where I put all these green dotted vertical lines. Look at where we are right now. Look at where we were at the bottom when I talked in July. And what happened when we were showing a lot of equity puts being bought versus calls? That's telling us that the market has gone too far to the downside. And what happened from July? Actually, this was the August low. I think I wrote an article about this, that it was poised for a bounce. What did it do? It bounced. And now we're back down, and look at where we are, still on this 10-day moving average above 0.80. The market is still incredibly fearful. I love it when folks write about sentiment and say that the market is complacent or that folks are bullish. I don't know what they're looking at, because this has been probably one of the best signals, is one of the best signals in the market and it's telling me that the market is incredibly bearish right now. The retail traders, incredibly bearish. They believe nowhere to go but down right now. That's why we're probably going to go higher. Anyway, I hope you enjoyed this Your Daily 5, just giving you something else to think about instead of listening to all the bad news that you're going to get in the media all the time. Listen, short term, we had problems back in July. Short term, we're starting to see some pretty bullish signals right now. Unfortunately, most technicians will follow the price action, and that's all they look at. Anyway, till next time, everybody have a great day. Hopefully we'll get this reversal sometime this week. That's what I'm expecting. Is it today? Is it tomorrow? Is it Friday? Maybe next week? I don't know. I'm watching the market just like you are. Very difficult to call the market in the short term, but I can tell you long term, I really love the market, and I think this is presenting us another opportunity. Anyway, have a great day, everybody. Happy trading.